अस्सलाम वालेकुम एंड वेरी गुड आफ्टरनून। आज एक बड़ी मजेदार बात हुई। दिस इज टर्म व्हिच इज कॉल्ड टीओटी। मैंने बोर्ड पर लिखा है टीओटी। टीओटी का मतलब होता है ट्रेनिंग ऑफ ट्रेनर्स। लेकिन आपको एक मजेदार बात बताऊं, टीओटी की जो टर्म है आपको अकाउंटिंग लिटरेचर में कहीं नहीं मिलेगी। क्यों? इसलिए कि टीओटी की टर्म को कनेक्ट किया आपके दोस्त, आपके टीचर ने, जिसका नाम है मुनव्वर हमीद मंगलवाला। इस वक्त आई एम एट NED यूनिवर्सिटी विद माय स्टूडेंट्स। तो बात करेंगे टीओटी की। टीओटी का मतलब अकाउंटिंग में हमने जो क्रिएट किया आपके लिए वो है ट्रांजैक्शन टू ट्रायल बैलेंस। ट्रांजैक्शन टू ट्रायल बैलेंस। अगर आपने ट्रांजैक्शन टू ट्रायल बैलेंस अच्छे तरीके से समझ लिया तो आप दुनिया के किसी भी कंट्री में जाके फाइनेंशियल रिकॉर्डिंग को मैनेज कर सकते हैं। दरअसल बात होगी सब्जेक्ट्स की। ऑल द सब्जेक्ट्स ऑल ओवर द वर्ल्ड आर डिवाइडेड इनटू टू साइंसेस, प्योर साइंसेस एंड सोशल साइंसेस। सोशल साइंसेस की बात करें तो सोशल साइंसेस की एक ब्रांच है इकोनॉमिक्स, विच इज द मदर सब्जेक्ट ऑफ सोशल साइंसेस। हालांकि सोशल साइंसेस में और भी सब्जेक्ट्स हैं। इकोनॉमिक्स को ड्रॉप डाउन करें तो हमें एक सब्जेक्ट मिलता है फाइनेंशियल इकोनॉमिक्स, एंड अकाउंटिंग इज अ ब्रांच ऑफ फाइनेंशियल इकोनॉमिक्स। अकाउंटिंग में दो किस्म की अकाउंटिंग जनरली हम बात करते हैं। वन इज फाइनेंशियल अकाउंटिंग which is external accounting, and second is management accounting which is internal accounting, cost accounting which is internal accounting। I mean ये एक ही तरह की चीजें हैं। cost accounting, management accounting, these all are internal accounting, these are related to decision making। तो सफर किस तरह शुरू होता है? सफर शुरू होता है ट्रांजैक्शन से। A transaction is the financial information which must be in past। जिस तरह हर जबान में लेटर्स होते हैं, अल्फाबेट्स होते हैं, इसी तरह से अकाउंटिंग के जो अल्फाबेट्स हैं वो बड़े क्लियर हैं। CLEAR, दिस इज ए निमोनिक। निमोनिक ऐसे वर्ड को कहते हैं कि एक वर्ड को खोले तो कई लेटर्स बने। C stands for capital, L for liabilities, E for expenses, A for asset and R for revenue। इसके अलावा और अकाउंट्स भी होते हैं, प्रोविजन अकाउंट होते हैं, कॉन्ट्रैक्ट कैपिटल अकाउंट्स होते हैं। हम इसको कुछ डिटेल में नहीं जाएंगे, हम बेसिक बात कर रहे हैं। वी वांट ए पर्सन ही मस्ट बी एबल टू मैनेज फाइनेंशियल रिकॉर्डिंग। अब फाइनेंशियल रिकॉर्डिंग करने का जनरली जो लोग तरीका करते हैं वो ये करते हैं कि ट्रांजैक्शन तक तो सारे लोग समझते हैं कि ट्रांजैक्शन इज ए फाइनेंशियल इंफॉर्मेशन व्हिच मस्ट बी पास्ड विद द मनी वैल्यू। फॉर एग्जांपल मुनव्वर MUNAWAR, मुनव्वर मेड एन इन्वेस्टमेंट इन कैश ₹100,000। This person is name is Munawwar. He made an investment। तो इस जुमले को पढ़ के पता चला कि दिस इज ए ट्रांजैक्शन। मेड एन इन्वेस्टमेंट, पास की बात हो रही है और मनी वैल्यू की बात हो रही है। मनी वैल्यू डज नॉट मीन दैट you are making the payment. It's quite possible you are not making the payment and you will make the payment. But in this case, Munawwar made an investment in cash. So what we are supposed to see? We are supposed to see that how many items are in this specific sentence. So one item is investment and second item is cash. So at first, whenever the transaction comes before you, you are supposed to see that what items are involved. The second question here, that is what is their type. So when we look at the book, there are only 5 types here. Either the cash is asset or liability, or capital or investment, or expense or revenue. So here in this case, when I made an investment into this place, and this is my trading company known as Pakistan, for example, so I've taken out some cash from my pocket and I'm going to put this cash into the business. So one item is cash, if this is the cash. And from where this cash has come? This cash has come from me. It means I should know that whatever resources are equal to sources. So cash is a resource which is being invested in this business. It means sources and resources are equal, and in accounting this is called accounting equation. Accounting equation says assets is equal to liabilities plus capital. So if I want to start my business by 100 rupees, if I have 100 rupees and I put this 100 rupees into the business, it means assets is based only on investment. But if I see, I don't have the money, 100 rupees I need, but I don't have 100 rupees, but I want 100 rupees. It means I want 100 rupees, but I have only 70 rupees. It means I will go for an external support, and that is loan of rupees 30. So accounting equation agrees. So where we were talking about number made in investment in cash into the business. So the first question was what items? So the answer is investment in cash. And the second question, what is their type? Then we came to know that cash is an asset. Why? Because of cash has an economic value. And the cash has come from where? The cash has come from the pocket of Munawwar Amin and is going in the pocket of Knowledge Pakistan. Here we need to understand the accounting concepts. In accounting, financial accounting we are discussing at the moment, and we are discussing about financial recording. So when we discuss about financial accounting, we should know that in accounting we have international accounting standards, international financial reporting standards, and concepts and the local laws. So here there is one concept of accounting, and that is called business entity concept, which says owner and business are two different things. Owner, you are not supposed to make the account for the owner, but you are supposed to make the account for the business. So now what is happening? We come back again to the four questions. The first four questions related to a transaction. What items are involved? Cash and investment. What is their type? Cash, asset, investment capital. Number 3. What is increasing and what is decreasing? So when I put cash into the business, in the business cash is going up. And investment is also going up. Why? Suppose if I buy another jacket, so it means I will get another jacket, so my jackets are more in number as well as my clothes, because the jacket is a cloth. So when asset is being invested by the owner into the business, it means on one hand cash is increasing, at the same time the investment is increasing. Here we are supposed to ask another question, and that question is based on a specific rule which is fixed by default. Fixed by default means if I ask you that what color of this board is, so you will say this is white by default. We cannot change the name of this color. And that is called Dept click. D-E-A-B, Dept. C-L-I-C click. And this is, if I will say in detail, so I will say rule of DR means debit recording and CR means credit recording. So what's happening? There was a person, his name was Lucas Piccolo, 1454. He introduced this rule and he says, whenever in a transaction, these 5 accounts are, whenever in a transaction, if the assets are increasing, we need to record the asset on one side of a T shape, and this is the T shape. And he says that you need to record on the left hand side, which means you record it on the debit side. And whenever asset is going down, you need to record on the credit side. This is fixed by default. Another important thing, debit does not mean increase. Asset is increasing, debit is not increasing. The credit does not mean increase, credit does not mean decrease. Debit and credit are like inverse and only two sides of a T shape. In the COVID case, I did a case for lungs, and that was a dialogue between Munawar Hamid and Lucas Piccoli. And you can read that case in which I discussed that Dept and NED are making confusion for my students. So there should be left-hand side and right-hand side, on which I will definitely work more. Anyways, we come back. So, what items are involved? Cash and investment. What is their type? Cash, asset, investment, capital. What is increasing? What is increasing? Cash, asset increasing, capital, investment also increasing. What is debiting and what is crediting? So, in this case, asset, cash is increased, so it is debited, and capital increased, so it is credited. So, case is something like this. Sometimes one account will increase, one decrease. Sometimes both will increase, sometimes both will decrease, but always one debit, one credit. It is quite possible there are 5 debit and 5 credit, but the total will be same. And this type of transaction is called compound transaction. It's also quite possible that there is only one side debit, there is no credit, or vice versa. This type of things I am not discussing now, but these things are called memorandum entries. We come back to this concept. Now what's up? Lucas Piccoli says, whenever expense assets of one, what did I make? This was clear, CNEAR. This is called a mnemonic. Here also I made a mnemonic, DEAD. Whenever expense asset of drawing is a contra capital account. When you put cash into the business, it's called capital. But when you withdraw cash for personal use, not for official use, that's called drawing. It's a contra capital account. It reduces capital from the business. So he says, we make a mnemonic, expense assets and drawing, whenever increase, we record on the debit side. It's ruled by default. Whenever liabilities, income and capital increase, we write on the credit side. So basically what's happening, the transition is here. Now the next thing, on this hand we learn how to treat with the transition and make the double entry. Some accountants prefer, what do? They say, whenever a transition comes, you use only one journal, and there are 5 journals which you will see after source document, the concept of source document. Some accountants say, we need to make only one journal, and that's called general journal, which is generally taught here in Pakistan as well, but the students are in first year, second year and so on. But the students who are doing their O-levels and A-levels, they are not studying only one journal, they are discussing 6 journals. So I teach to my students in such a way that I cover both the aspects. Now we go back. So transition was here, Munawar made an investment in cash, or Munawar bought a pen by cash, that is also a transition. Now whenever there is a transition, it needs a proof. And that proof is in shape of a paper. And that paper is called source document. Have you ever seen any source document? Your Karachi electric bill is a source document. Your fee chaman Saad is a source document. I entered into Nahidi store, I bought something. The person who is at the gate, I am showing him what? Source document. Source document means the proof of the transaction. Now what happens? Now we go further. After making the source documents nowadays transaction is there. Coding is there. You can immediately create the source documents. Now the next step. The source documents are transferred in journals. If you are doing, the size of the organization is small, so you are making only one journal, which is called journal. It means in journal, Usman, whatever is the time, you record each and everything in journal. And journal has a format. On that format, you record the transaction. But suppose if you do not want that, if you want to keep everything separate, you use 6 journals. And these 6 journals are called, now before I discuss what type of transition, this will give you a direction that in which book this transition will go. For example, if the transaction is related to cash, it will go in the cash book. So cash book is a journal. Now I'm discussing 6 journals. So how many journals we have? 6 journals. I refer this thing to all the students all over the globe. So that whatever they are doing in accounting, the business accounting one by Frankfurt, it is always available. It is already available on the web. You can download the book and at first you read chapter number 11. When you read chapter number 11, you get an idea that how many day books are there. So in this chapter, you will find the text, which is generally people say theory. No, don't forget about theory. This is the text. So when you read the text, you get the idea of chapter number 11, which is all about 6 day books. And further, when we go to layers, it will provide you the idea of layers as well. I will discuss about the layers. I'll come back. So what is happening? The thing is this: if there is a cash transaction, you record in a book that has a specific format that is like a T-shape. On one side, you record all the receipt things. On the other side, you record all the payment things. If the money is coming in the cash, you record on the receipt side in a column which says cash column, receipt side cash column, and you record cash number there. If the payment is coming through bank, you record on the bank in the bank column. On the other hand, if the payment is you are making the payment, so cash is going out, so there is cash column there as well. So you are recording in the cash column, and if you are making the payment by check, you are recording in the bank. So either you record on the receipt side or the payment side, one thing. The second thing, it is quite possible in the business that some cash is being transferred from your cash box to the bank. So one side bank is improving and cash is going down your own. This is not an external transaction, it is the internal transaction, and this type of transaction is called contra transaction. Sometimes this is also possible that you sold something to Mr. A of 100 and then you called him, please give me the money. I want for 15 days gone, and he says the payment date is after 20 days. You say, okay, no problem. You give me some money now, I will give you some rebate. It means I will give you some relaxation in the money, which is called discount. Discount basically is of two types, trade discount and cash discount. This is a separate concept. So what happens, instead of receiving 100 rupees, you receive 90 rupees. You are supposed to receive 100 because you sold goods to me of 100. But now you are saying, some number I want an early payment, so I am giving you 90 now. So 10 rupees you say, okay, fine, finish. And that is a discount. It means in cash we have 3 types of transaction. Simple transaction, either payment, receipt or payment made. Number 2, contra transaction, transfer from this end to this end or vice versa. And third is discounted transaction. Either you give the transaction discount or you receive the discount. In the cash book, the specific format is here. It means all cash transactions are recorded in the cash book. Some number I want to read this thing cash book in detail, so you need to go for chapter number 13 of Frankfurt Business Accounting 1 by Frank. Now we come on the credit transactions. In the business, there is stakeholder. You people, me, we all are economic agents. Economic agent is a person who looks at his benefit. We all are here. Why? Because we are looking at our benefit. So many times, sometimes what happens, organizations are buying and selling on credit. Here on credit means on account. Here it means that we are not making the payment immediately, but later the payment will be made. And that is a credit transaction. Now what happens? If you are buying on credit, what buying on the credit? Inventory. Inventory means those goods which you buy for resale. That is called stock. The another name is merchandise. Inventory, merchandise, goods. The direction is there in IAS 2, International Accounting Standard number 2. You will read. You understand the background of the inventory. Now what happens? Inventory management is also a concept. But here we are just discussing one thing. I bought inventory from Saad, from Ibrahim, from Usman. I bought inventory on credit. It means this transaction will not go to the cash book. It means for this transaction, I have another concept. I bought, it means I am going to make a day book, another journal, daily recording book, and the name of that book is purchase day book or the purchase journal. It means whenever you buy on credit, you need to record in purchase journal, and that is a list. And that list will record each and everything which is related to your credit suppliers. Ibrahim, on the same way, we can sell goods also on credit. So if I am selling goods to you, it means the first thing is the invoice, and invoice you will always make invoice after the transaction. Either this is a cash transaction, cash payment, or this is a credit transaction, invoices, bills. There are many types of invoices: cash memo, bill, challan, debt note, trade note. Chapter number 11 will tell you each and every detail of these things. We come back. If you are selling goods on credit here, the credit is this side. But here when I am using the term credit, it doesn't mean this side, but this credit means on account on loan. So when I sold goods on loan, now I will not go in cash book. This is not a buying transaction, so I will not go in the purchase day book as well. So Ibrahim and Usman here, Taha and Uzam, here we have another book, and that's called Sales Journal. Sales Journal is also having a format: date, name of credit customer, reference number, and amount. As we had for the purchase day book. Purchase day book has the same thing: date, name of supplier, amount, reference, and amount. So we learned two books. These two books, and the cash book was the third one. Now we come fourth and fifth. Four books are related to inventory. Two conditions: sale or purchase, or return of inventories, one condition, and number two, on account, no cash transaction. Cash will come later, which will be recorded in the cash. So now what's happening? When you're buying the goods on credit, you need to record in purchase day book. When you're selling the goods on credit, on account, without the payment, you're recording the sales day book. Two books are covered. Now the third one. I sold some goods to Taha on credit, and Taha said after a few months or few days, he says, "Sir, this thing is not correct. This is not accurate. This is not as to standard." Now this person is going to return goods to me. And because of I did not receive any cash immediately at that time, it means again I am not going to return the cash. But for that I am going to make another book, and that is called Sales Return Day Book. In the Sales Return Day Book I have credit customers. Same format: date, name of credit customer. Here we will not write invoice number the column, we have another column, note, and finally the amount. And the last thing is what? The last thing is purchase return day book. Sale return book, another name, return invoice day book. Purchase return, another name, return outward day book. So now I bought something from Usman. 5 markers. One marker is not up to standard. So I am going to return that marker to you. So my liability is going down. So it means I am making another day book in which I have the name of my credit suppliers. By this, how many books are created? 5. Cash book, sales day book, purchase day book, sales return, purchase return. Now, the last book, that is called journal. That's the same journal which American accountant generally make, not the British accountants. British accountant makes 6 day books, but American accountant not always make the 6 day books. Generally, they make one book, journal. So that's the same journal, but their approach is different. If you are making only one journal, either you are a British accountant or Pakistani accountant or American accountant, it means you are just having one book, journal, and second book, cash book. You are not maintaining any sales day book, purchase day book, sales purchase day book. You are recording each and everything in journal. And journal has also a format. The first column is date, second column is detail, and third column is reference, and the fourth column is debit, and the fifth column is credit. Now in this journal, you are supposed to follow the same rule which I told you about 4 questions. Date, detail, reference number, debit and credit. Munawar bought a pen by cash. Now suppose Munawar bought, now this transaction, it will go in the cash book. Munawar bought a pen by cash and pen is in inventory. It means that it will not go in cash book, it will go in purchase book because of this is inventory. But suppose Munawar bought a van or a car on credit. It means this transaction will not go in the cash book. This is not a sales transaction. This is neither a return transaction. And the car is not that item which I bought for resale. Car I have purchased for business use. That is a capital expenditure. So this type of car which was bought by me, by my business, me and business, two different things, business entity concept. So when I bought this car on credit, I need to record in the journal. In the journal, I need to record in such a way that the first column is date 21st of January or on my birthday, 10th of August, car on the first line, car, debit. In the second line, this is the car, then the second line is accounts payable. I am supposed to make the entry like this. I will make it here for you. Car, debit, whatever is the amount, and account payable, credit. So this is basically column, date column, particular column, debit column, credit column. And what do? We leave some space. And leaving this space is called indentation. Whenever we write a journal entry, we make an indentation. We are near to close. Now what we need to do? We need to write something what has happened. And that is the brief of the transaction. Bought a car on credit. And this thing is called narration. Up to here, I discuss only day books. It means I cover journals. Some number I want to read in detail. Yes, you should go in such a way. When you go for chapter number 11, you get the concept. When you go for chapter number 13, cash book should be created. When you go for chapter number 14, you will understand about sales day book. When you go for chapter number 15, you understand by purchase day book. When you go for chapter number 16, you understand by return day books. And finally, when you go back for chapter number 17, you understand the journal. Now, the next item, that is called ledgers. The ledgers means those big softwares in which you have separate accounts. Account T-sheets like this. So these are three big software. One is called GL, Journal Ledger. One is called sales ledger, one is called purchase ledger. If the business is small, there is no need to have three ledgers. They have only GL, Journal Ledger, in which they have accounts. Now, I discuss one by one. I sold some goods to Taha. It means I created an invoice, credit transaction. After making the invoice, I covered the sold document, transaction, I sold goods to Taha, sold document is there, invoice. Then I went to the journal in which I went to sales book. And from sales book now, I am going in a ledger and that ledger is called sales ledger. In the sales ledger, I have those accounts which are related to credit customers. And I have all different accounts. For Usman, a different account. For Saad, a different account. Because all people are different. And these accounts are called personal account or subsidiary accounts. And whenever you are writing, for example, Taha, this is the Taha account. Whenever you are writing on this side, it means Taha is being debited. Because my claim is coming on Taha. So one side Taha is being debited. Saad is being debited, Ibrahim is debited, Usman is all people are separately in T accounts are debited, and these all T accounts are in one big book, and that's called sales ledger. So one side of the debit entry is complete. Every debit has a credit. Dual aspect concept says every debit has a credit. So Saad, now I need to go in another ledger. What was the activity I was doing with you? Sales. It means now I need to go in another big book. In the title of that book is Journal Ledger. In the Journal Ledger, you need to create an account of the revenue. Because when I sell new goods, that's my revenue. It means I need to open the sales account. So on one hand, I'm going to open what? I'm going to open Taha account, Usman account, Ibrahim account, Usam account, Saad account, and on the other way, in the journal ledger, I'm going to make a sales account. Now, at the time of purchasing, if I'm buying something from Bismarck, something from Unzita, something from Yemen, something from Iman, so these are my credit suppliers. It means all these people by whom I bought the goods, first I will have an invoice, sold document. The sold document will go in the purchase day book. As here it went to sales day book, here it will go in purchase day book. And there from sales day book I went to sales ledger, in which separate account, and then general ledger sales account. Similarly here, I am buying from these people. It means separate invoices, separate bills. Then the data will go the next order, and that is purchase day books. Purchase day book is a list in which I have all names together. And then from purchase day book, I am going to the next stage, which is this stage, in which I am going to make a ledger, and that is ledger, purchase ledger. Because of these are my liabilities, so I'm supposed to write the name of these all people on the credit side. The number will be written on the credit side, like Iman and Aman. So these two accounts were in the purchase ledger, and these two accounts, for example, Saad and Taha, these two accounts are going in sales ledger. So sales ledger, people are being debited. These are credit customers, and finally sales account credit. Here what you are doing, you are crediting Iman and Aman because these are my liabilities. My liability is going up, and the rule says that whenever your liability goes up, you record on the credit side. So one side is complete. So what was the transition with them? I bought goods from them. It means I need to open a purchase account as well. In the purchase account, for purchase account I use the same ledger which was the GL. Final thing. In general ledger, we have called nominal accounts and real accounts. Nominal means income or expense account, and real means asset account. Now, I am coming to the end. So when I have written the number inside the accounts, this thing is called posting. In the day books, I am entering the data, the number are written, that's called enter the data. But when I am writing the number in the ledgers, in the T accounts, that's called posting. Finally, what happens? You know, sometimes women, they are in the kitchen, they are making korma, and suddenly they feel the salt is okay or not okay, they just taste. Now we are going to taste. These T accounts are prepaid, and finally, some number in every account, either only one side or both sides, both numbers are equal, it means account is closed. And sometimes this side is more than this side, it means balance will be here. 10 minus 7, 3, debit balance. Create balance here. For example, 9 minus 2, 7 here. So these final balances will come out from the T account, and we need to record in a list, and that list is called trial balance. Trial balance is a list which shows arithmetical accuracy, and when you make the trial balance and the trial balance is correct, it means it is not necessary the trial balance is accurate. Another twist, in trial balance it is quite possible that there are 6 types of errors which is not the topic of this point of time, and that is called cockroach. C-O-C-R-O-B. I make another mnemonic. Cockroach, commission, omission, compensation, reversal, alter, and principle, which we will study later. At the moment, I want to say only. Suppose something you received, you bought a book. You did not record book on the debit side and cash on the credit side. It means no debit, no credit. So at the end of the day, when the transaction was omitted, trial balance will be same again, because other transactions are there. So finally, what is happening? When you make a trial balance, and if the trial balance, if that is agreed, means you understand accounting cycle. Up to here we concluded, we are going to conclude, but before that I will tell you what I can read from them. So if the trial balance agree, it means each and everything from mathematical accuracy point of view is correct, not from conceptual point of view. Now you read, start reading like this. You read at first chapter number 11. It will give you idea of all things in a big frame. Then you start reading chapter number 13. In chapter number 13 is all about cash. So cash says when you make a payment for expense, so cash is going down, cash credit. Understand me? Listen to me. Expense is debit. It means half entry is in the cash book and half expense entry will be in general ledger. It means you need to open a T account in the general ledger as well for the expenses. Now the double entry is complete. Interesting thing in the cash book. The discount column of the cash book qualifies a cash book that a cash book is a book of prime entry as well. So cash book is a book of double entry. It means half entry is in the cash book and half somewhere outside in the T accounts. But when we talk about cash book as a book of prime entry, it means we're just writing the number of discount in the cash book. But both the discount and receivable person, or the discount received or the payable person, both the accounts are out of the cash book. So why you are showing the number in the cash book, discount number? This qualifies cash book as a book of prime entry. I want you to read chapter number 13 to understand each other thing. Now we come chapter number 13, chapter 14. Chapter 14 is about sales book. You are selling books A, B, C, D, E. You are issuing invoices separate. So document. Now the data will go in a book, and that is sales book or the sales journal. It will be writing in one book, in one page. Munawar, Taha, Ali, Nusad. You are writing the name of all the people. You are writing the names and the amount. No double entry here. It means in sales book you did not make any double entry, and without double entry, accounting is not possible. So now sales book, from sales book you are going two ledgers. One in the sales ledger where separate account of individuals, you are supposed to debit them because this is your claim on those people. They did not make the payment in cash, so you are having a claim. So that claim is called account receivable. So you are opening separate account receivable account. And then what the activity is sales. So basically you go in the journal ledger and the checkbook in which you have an activity account, and that activity is called sales. So double entry is complete. 10, 50 rupees, and 50 rupees by complete 50 rupees, by one number of 50 rupees, you are going to open the sales account. Double entry is complete. Now we come to the next chapter, which is chapter number 15. Here we discuss about the purchase. I bought from Eman, I bought from Bisma, I bought from Unzila, I bought from Fatma, from Amna. So these are my great suppliers. So I'm going to sell them, so I'm going to buy from them. It means I'm having the invoices, the bills which I receive from them. And then I'm going to transfer my data where in the purchase day book. Purchase day book is a list which is called purchase journal. I have the name Fatma, Eman, Amna, Iman. I take the name, I take the total, I'm entering the total. My day book is complete, but no double entry. So now to go to the next step in the double entry, what I'm going to do, there I open purchase sales ledger. Here I'm going to open purchase ledger. In the purchase ledger, I have customer, supplier, individual account, personal or subsidiary account. All people are being credited. And what was the activity? Purchase. So I need to open a purchase account in the same journal ledger where I had the sales account. You must understand. Purchase invoice is something different. Purchase daybook something different. Purchase account is something different. Everything. Chicken tikka and chicken biryani are different items. Chicken plow is something different. Which today, what is our name? Saad. These people have eaten without us. So bottom line is what? Bottom line is this all account. Finally, we go in chapter number 16. Chapter number 16 are retail transactions. So when we sell the goods, we make the invoice. When we bought the goods, we received the invoice. But when we return the goods, I bought from them and now I'm returning the goods. So my liability is going down. So here I am again, Usman issuing a document, and that document is called debit note. The goods which I bought I am returning. So I am giving them the goods as well as a paper, and that's called debit note. It means my liability is going down. Similarly, on the other hand, when I sold goods to you and you returned it to me. So when I sold goods to you, I have debited you because you were my claim. So now when goods are being returned to me, I am crediting you, which means my claim is going down. So I am issuing a credit note. So the story is there in chapter number 16 about return. You make the return day books, you enter the data, and from return day book, because the data is, it is a list. And my dear, from the list, the data is going in the ledger. Same ledger. When you sold, there was a sales ledger and general ledger. Same ledger. Their Usman account is there. This time, the same ledger Usman account is there. I am supposed to credit Usman account because the goods are returned to me. And the same ledger, general ledger, there I am supposed to open a sales return account, activity account. Similarly, for Bisma. Bisma bought goods from me. I bought goods from Bisma, so she was my creditor. So when I return the goods, effective goods, it means my liability is going down. So I am supposed to issue her a debit note and then a book, purchase return day book. And from purchase day book, I will go in the same ledger, purchase ledger, where Bisma's account was there and her number in her account was on the credit side. So now I am supposed to debit her. Account either closed or the number has gone down. And finally, I go in the general ledger. In the general ledger, I am supposed to open purchase return account. Final is chapter number 17. And in chapter number 17, and now, for example, the value of non-current assets is going down, and that's called depreciation. So these types of transactions we record in the same format which was journal format. We record in the journal. Like I sold goods to Ali Hassan and I recorded in the books of Hussain Ali. Not the same person. So the correction will come in journal. And when I record the data, look at the board in a journal in this shape, the work is not finished. Because of I am at this level and the next level is ledger. It means I need to go in the ledger. There I will open the account of depreciation expense, because of depreciation nobody is taking. It's a non-cash item. So cash book says I will not take. This is not an inventory transaction. So 4-day books are saying we are not taking. So it means only journal is left. So I am recording these type of transactions in journal. Then I will make the T account, the respective T account in journal ledger. And finally what happens? Before I go to the trial balance, I must read chapter number 17. And if you want to learn in a proper way what the T account concept, you can understand from chapter 5. You can understand day books and T account both. From 13 here, 13 here, 14 here, 14 here, 15, 16, 16, 17. It means the T accounts are understood not only by the respective chapters but also from chapter number 5. And definitely in chapter number 13, the accounts are given. Finally we come at trial balance. Trial balance is a list. It has all clear accounts, CLEAR, all capital, all liabilities, all expense, all asset, all revenue. But the total will go there. Total will go there, and the format is name of account, debit and credit. And the last thing, trial balance is prepared on that click. First column, name of account, second is debit, third is credit. It means in the trial balance, expenses, assets and drawing, the number will always in the debit column. Click means liabilities, income and capital will be always on the credit side. So when both these sides are equal, it means your trial balance is balanced. a wonderful question. After reading chapter number 6 and chapter number 17, which is related to journal, the journal, chapter number 17, the journal, as I told you here. When you read these two chapters as well, and you trial balance, you understand trial balance, it means you are able to create the financial recording for any organization all over the world. And we should be thankful to Mr. Frankfurt, who has created a wonderful question, and the question is 17.3, which you will have to solve. This will be a project for you, that you will solve in such a way that you use computerization in this. We will discuss in the class as well. And this question we can solve at least on 10 to 12 pages. In this question, all transitions, all tables, all 3P accounts in which they are different, all 3 ledgers in which they are different 3 accounts, and finally the trial balance. This was a complete set of TOT which I have just created today. I am very thankful to Mr. Maratara that has given me this approach, this, this has come in your mind suddenly, TOT, transition to trial balance. And you can solve this and you will see that it's a wonderful journey. Thank you very much. Assalamu alaikum. Pakistan Zindabad.